Thank you, everybody. So our session now is how can investors and developers work together to build a subsidy-free CCUS market? I'm Clair Thornhill. I'm an Associate Director in Frontier Economics Energy Practice. So we're a consultancy that works for investors, governments and regulators, the UK, Europe and beyond. So delighted to be here today with four brilliant speakers, and I'm going to introduce them all as they begin to start their presentation. But just to say, we've got Valborg Lundegaard from Aker Carbon Capture, Steve Lomas from the UK Infrastructure Bank, Toby Lockwood from Clean Air Task Force, and Allan Baker from Societe Generale. So delighted to have them all here. Bit of housekeeping before we get started. So there's a policy of no photos or videos during the sessions. All of our speakers are going to do an 8-minute presentation, and then we'll have Q&A. And the session is being live streamed, but it's a one-way live stream, so those watching it unfortunately won't be able to ask questions, but we will be taking questions from everybody that's here. And I think, one last thing, the presentations will be made available on the Canopy app afterwards. So just to before I hand over to Valborg. So what are we talking about today? In the UK, it feels like things are beginning to get going. So the Track 1 clusters have been announced, the Phase 2 projects have been shortlisted, and the business models have been developed. With all of this, there has been a big increase in interest from investors. And what we'd really like to dig into today is the importance of a supportive investor community in this area, and really what needs to happen to get us to that subsidy-free, stable world that we're all aiming for. So with that, I'd like to introduce Valborg Lundegaard, who has more than 30 years of experience working in the energy industry. So in 2020, she was appointed CEO of Aker Carbon Capture, which is a publicly listed pure play company which aims to accelerate planet positive investments, particularly in the carbon removals area. Valborg, over to you.
Thank you very much, Claire, and good morning, everyone. Still morning, waiting for lunch. All right, I have some slides, and you listen to a whole session without any slides, so hopefully this is welcome. Starting with a short introduction to our company. We were listed as a pure play company 2 years ago. And I would say finally, because now the market, the CCUS market started moving. We got a lot of requests from our customers, and we were so ready with our technology. Because we had been developing carbon capture technology for almost 20 years. And back in 2008, we built a mobile test unit, and this mobile test unit has been tested our technology on various flue gases around Europe, but also in North America. And in 2012, we delivered the large technology Center Mongstad, 80,000 tons per year, which is the most sophisticated test center for carbon capture in the world. So in 2020, when the market was ready, we were ready, and our technology was proven. And that is actually all I'm going to say about technology. It's proven. And that is really, really important, because there are so many companies and people who believe that this is something new. No, we are ready to deliver projects right now, and we are doing it. We had to prioritize. So we prioritized Northern Europe, with Scandinavia, Benelux, and UK leading the way. And the reason for that being not only because we had a lot of requests from customers, but also we saw that the regulatory regime was more mature in this region. And then we prioritized some of the industry segments that we would work in, even though our technology had been verified for others as well. So we selected the cement industry, where CO2 emissions comes directly from the cement process. We prioritized waste to energy, including bioenergy plants. We prioritized blue hydrogen and gas to power plants. And now there are 2 large projects for carbon capture in construction phase in Europe. And we are delivering both of them. The first one is our flagship project in Norway. a carbon capture plant of 400,000 tonnes per year to Heidelberg Cement. It's an existing cement facility. It's been there for decades, and we are integrating our carbon capture plant very much into this existing facility with excess heat available. This carbon capture plant is part of the full value chain Longship, which will be in operation in 2024. And right now, equipment is being installed at the site, and we are doing piping. And then over to the Netherlands. Here we are delivering one of our standardized plants, a 100,000 tonne plant, to Twence, a waste-to-energy provider. And this one is so standardized that we can deliver in less than 2 years. So this plant will be in operation by the end of next year, and the CO2 will be used as fertilizer at existing greenhouses. And if you compare this plant with the technology center Mongstad that we delivered back in 2012, the capture capacity, it's not that different. However, when you look at the footprint and the cost, it's extremely different, because this is what we've been working on all these years to get the cost down. And both footprint and cost have been reduced with almost 90%. But also then in the UK, and these projects has been mentioned today already, the very large, impressive gas-to-power plants with CCS. And we are the carbon capture provider, both for Net Zero Teesside project and KidB3, where we are working with a consortium of Aker Solutions, Siemens Energy, and Doosan Babcock. These projects are in the FEED phase, but they are extremely important in the UK market and in the overall hub thinking of decarbonising. And the UK market is so important to us, not only the gas to power segment, but also the waste to energy segment, as one example, that we will set up an office here in London, which we'll enter into in a couple of months. This is the slide that most of our customers and investors and everyone I talk to really like best, because they all ask, what is the cost of CCS? And what you see here is what we can offer as a one-stop shop when we deliver our standardized 100,000 tonne plant, which we call Just Catch. And here we can offer the full value chain, because we saw it was really complex for many of our medium-sized customers to understand the CCS industry. It's easy if you work on it day and night, like many of us do, but to these customers, this was completely different business than they were used to working on. So we said, we can handle all of this for you. We will make sure that the plant is financed and owned by a separate company. It could be a yield company within Aker or a third party. And then we will build the plant, we will operate and maintain the plant, and we will work with partners to ensure that it's transported and safely stored, the CO2. And right now, what we see is that we can deliver such offering. They only pay per ton CO2 capture between 70 and 150 euros per ton. So why these variations? When you look at the carbon capture plant itself, you know, the driver here is to get the cost further down, get more serial production. When you look into the operational phase, energy cost is a big driver. And why is it possible to get it that low? It is because some of our customers have excess heat available. And that is really what we are seeking now as the first movers. And then, of course, the biggest range you see in transportation and storage, because we need to have a storage solution which enables short transportation, which again then, of course, reduces the cost. It's not only one quick fix to accelerate this market. So what does it take? Well, it's easy to point at others, but I'm starting with ourselves. I'm starting with us as an industry. What can we in Aker Carbon Capture do to accelerate the business? And yes, as I said, we are working on serial production, modularization, standardization, working with our suppliers. This is the success story that we have demonstrated since Mongstad, and this is what we're also going to do with our larger plants. And then, of course, there will have to be technology development, even though we have a proven technology right now. But we are working with startup companies, with universities and so on, because we can also commercialize technology. This is something that we've learned over the years. And then there needs to be the full value chain. There needs to be transportation and storage available. And right now, storage is a bottleneck in Europe. Northern Lights is the first mover here, operational in 2024. But if we're going to meet the targets set by each country for 2030, we are late. There will be plenty of storage, hopefully. At least there are many plans by the end of the decade. But it's coming too late to really move forward right now. So this is what I'm pushing. We need storage. And here we work with various partners on storage because we want to make attractive solutions. And partnering is essential here. Also, when we look at business model, like our carbon capture as a service model, the one-stop shop. And then, of course, it's governments. And it's easy always to point at governments, but they play a very important part in this industry. And there needs to be mechanisms that accelerates the industry. And there are various ways that has been selected. In Europe, it's been stick. It's tax, CO2 tax. Okay, that works, and also in the end. But there must be incentives in the beginning that really promotes those bold first movers so we can get this industry moving. And then it needs financing. And it's always interesting to follow United States because they have a different mindset. They always think business, business. And here it's a business incentive, the Inflation Reduction Act, the 45Q, that really gives them tax credit if they implement. But the most important message is that governments must ensure that it's more attractive to implement CCS and reduce CO2 emission than to continue to be an emitter. And then, fourth dimension is financing. And I can tell you, since we've been out there and talking about our carbon capture as a service offering, we need financing. And there are lots of private funds that are interested in that. So there is money available. But we have to provide some interesting opportunity. And the governments need to provide long-term predictability. So it's attractive. And then, together, we can solve it. Together, we can accelerate. And this is what needs to be done. And we don't have much time. We have to start right now. And we have all the building blocks. So let's do it.
Well, thank you, Valborg, for a really excellent presentation. And for those of you standing at the back, please do come and take a seat. There's loads of seats at the front. Brilliant, and I'd like to introduce Steve Lomas. So Steve Lomas is Managing Director, Banking and Investments at the UK Infrastructure Bank. During the last 2 years, Steve has played a leading role in the setup and launch of the UK Infrastructure Bank, and he co-heads the banking team and has done during the first year of its operations. Steve, over to you.
Good afternoon, everybody. I think we're in the afternoon now. What I wanted to do today was really just talk through a little bit about the bank's first year, the type of deals that we're looking at, and the role that we can play in supporting, potentially supporting CCUS. So the bank was actually established June 2021. When I joined the bank, there were about 6 people in the office. We've grown over the last 12 months to about 160 people. We are quite unique. We have a single shareholder, which is HM Treasury. We operate UK-wide, and our main objectives, twin objectives, are to help tackle climate change and to support regional and local economic growth. As we've got up there, we've got £22 billion worth of financial capacity, and that is split between debt, equity, and guarantees. So of that, £4 billion has been allocated for supporting local authorities. We've been building the team over the last 12 months. We've been starting to do transactions, and we've now onboarded our full ExCo. So what are our investment principles? We sort of have four key underlying themes. I mean, first and foremost, projects, they need to be either infrastructure assets or in infrastructure networks. We'll also support technology that supports infrastructure as well. The second is that the projects either have to support a net zero principle, clean energy projects, or they have to support regional and local economic growth. So it has to tick one of those two boxes. The third limb is that we want to make a positive financial return. We're not a grant-giving organisation, but we're a policy bank. We have a sensible return target of between 2.5% and 4% over the first 5 years, after the first 5 years. So it's a sensible approach in terms of return. And the fourth sort of key plank of our mission statement is we want to be additional. So we don't want to crowd out. If we're not needed in transactions, then we won't enter those markets. But when the bank was established 2 years ago, and a lot of the discussions around looking at the forward pipeline, we were looking at projects, and actually CCUS was one of those areas stated in the bank's initial framework of why the bank was being established. So new technologies or scaling up technologies that have been used before into new asset classes. And I think, you know, CCUS, hydrogen, are certainly two of the core areas where we see a lot of inquiries and a lot of discussion at the moment. So during our first year, we actually issued our first strategic plan in June of this year, actually. What we're trying to set out in that plan is looking back over the first 12 months of the bank's establishment, the discussions we've had with the markets, where are the financing gaps, where does the market see that we can play a role. We've got 5 priority sectors: clean energy, waste, water, digital and transport. And I think when we issued that strategic plan, we were looking at a bit of a deeper dive into some of the more difficult areas for financing projects. And one of the sort of key messages that was coming back from the market, and it's been mentioned already this morning, is first of a kind projects. Banks, investors, you know, will struggle with those sort of deals. And I think there is a view that we can play a very important role in helping to crowd in, provide a halo effect into some of these early transactions. And we're starting to get those inquiries, certainly in the CCUS space and also the hydrogen space. Yeah, having been in project finance the last 25 years, you know, there is a reluctance to do a first-of-a-kind deal. Obviously, as we've heard, investors and banks are really keen to support clean energy and the transition to net zero, but we still need to, you know, the risk appetite of those institutions, I think, still need to be tested. So where are we today? This is a list of the sort of inquiries that we've seen over the last 12 months. Many of the inquiries are coming in looking for sort of early development capital. I think on the equity story, we're not quite there yet in terms of direct equity. We have invested equity into funds, and the next stage of our journey is to look at supporting projects with direct equity. That'll probably be, as we build the resource, that'll probably come towards the middle of next year. As I said, CCUS was specifically highlighted in the bank's original framework document, and we see going forward that clean energy, if I roll forward 5 years, clean energy will probably be around 50% or more of our entire balance sheet. So it's certainly an area where we think we're going to get a lot of inquiries and we can provide a lot of support. Like the rest of the market, we will be driven by deal pipeline. This year we've seen significant activity in the digital space, and we've been following that, and we've supported a number of transactions in delivering those deals. So, you know, as has been mentioned this morning, there is competition. Competition both within other sectors within the UK, but also overseas. and that capital will have choices in where it wants to be deployed. So I think a pipeline is really important. It's been mentioned this morning. I think the market is looking for a pipeline. And certainly in CCUS, there have been some false dawns in the past over the last 10 years, but it feels like that momentum is now building, and inquiries are starting to sort of, I think banks are now engaging in this process. We certainly have taken a number of inquiries and are talking to a number of the sponsors and developers in this market. So, as I said, you know, it's still to be tested whether the UK Infrastructure Bank will be needed in this space, but clearly, given the sort of nascent nature of these projects, we believe that there is, you know, potentially and possibly a role for us. I think in those first early deals, we may be needed to sort of help draw in other banks and investors, and we can provide that sort of halo effect, similar to how the EIB were first involved in offshore wind 10, 15 years ago. I think the message I want to leave this morning is, you know, we're certainly open for business, we're willing to engage, and we're looking forward to sort of developing, you know, our product range, whether it's debt, equity, or mezzanine finance, across projects such as CCUS. And I think we can play an important role in drawing in and crowding in the private markets. I think there is a question around subsidy-free CCUS. I think there's a further question around what that definition really means. I think if we look at other sectors in the renewable space, yeah, we are now in a sort of subsidy-free world. You know, pre-recent events with the prices of the CFDs coming down significantly, and that's been driven by deal pipeline has helped to bring the technology costs and construction costs down of those technologies. We've seen it in offshore wind, we've seen it in solar. I think it's a little bit early in my mind to really be talking about subsidy-free CCUS at this stage. I think what we really need to be doing is sort of delivering those first deals that will then get us onto the potential curve in terms of delivering subsidy-free CCUS over the next 10 or 15 years. So my sort of final message is, you know, we're open, we're ready, we're closing transactions. We've closed 11 transactions this year of totaling around £1.5 billion, and we'd be delighted to have conversations with projects in the CCUS space. Thank you.
Thank you very much, Steve. Great to hear about your work crowding in investment in this area. So now over to Toby Lockwood, who is Director of Technology and Markets for Carbon Capture in Europe for the Clean Air Task Force. So in this role, Toby leads the Clean Air Task Force and analytical work on carbon capture's potential to contribute to net zero in Europe. Toby.
Thank you, everyone. Let's just do the slides. Yeah, thanks for the introduction. For those of you who don't know Clean Air Task Force, I'll just give a brief introduction. It's a climate NGO founded in the US about 25 years ago, recently expanded to Europe and other regions, including the Middle East and Africa. So I'm working in Europe. Our mission is to create an affordable zero-carbon energy system by advocating for pragmatic policies which are really rooted in technology innovation and optionality. So as part of that, we have several work areas: methane mitigation, zero-carbon fuel development, nuclear power, and carbon capture, of course. So I was asked to talk a bit about the US, representing a US organisation. I think we've heard a lot already, but worth highlighting the key role that my colleagues at CATF have played in developing and passing these pieces of legislation. One we haven't heard so much about is the Infrastructure Investment and Jobs Act, which was passed late last year, which has put over $4 billion in low-interest loans and grants into transport and storage infrastructure, and is also funding for direct air capture hubs. So that's key. And then also, of course, we have the 45Q enhancement, which has raised the tax credit per tonne of CO2 stored to up to $85 per tonne, and allow companies to claim on a direct pay basis. So with all that, we are seeing a lot of activity in the US, as we have. We have this map on our website, which maps projects proposed in the US and Europe. There's about 130 projects proposed in US at the moment. 30 of those came in this year. We're seeing that across all sectors, in a few key regions, the Midwest, the Gulf Coast, the West Coast in particular. And as I'm sure you've noticed, there's project announcements coming in every few days now in America. So what's happening in Europe? Similar map, a lot of proposed projects, there's over 60 here, but how many actually have a commercial case to go ahead? Well, it's much fewer, of course. We have nationally supported or projects which look likely to receive national support in North Sea countries, the UK, Denmark, Netherlands, Norway, and there's 8 projects in pink there which are receiving funding under the EU's, or have been selected by the EU's Innovation Fund, which also provides sustained revenue over the lifetime of the project. As we've heard, only the Longship projects are under construction now, the one in Brevik and the waste-to-energy facility in Oslo. So in the US, we've heard we have a lot of carrots. In Europe, it's more about the sticks. The biggest stick is the ETS, which has been high for the last year and a half. And there's even bigger sticks in Netherlands and Denmark, where carbon top-up taxes are being implemented this decade. And that's really making industries start thinking about acting. Another key thing which has unlocked, which has enabled these industries to start thinking about CCS to escape the carbon price, is the access to North Sea storage, which we're seeing provided by projects like Longship. But the problem is everyone wants to use that same storage. As we heard in the last presentation, there's a massive shortfall projected in 2030. We think the demand could be twice as much as supply in storage. And beyond that, a lot of industries really protected from the carbon price by free allowances. So fundamentally, the key problem with the carbon price of driver right now is it's not quite high enough. We're developing this tool with carbon limits, which maps transport and storage costs, estimated costs across Europe in a few different scenarios. On the left, you see kind of the current situation with a few storage sites proposed around Europe and no new pipelines. We can see the cost can come down if we have new pipeline networks, new storage sites. There's a lot of potential geology across Europe, of course. So I wanted to answer the question how to move beyond subsidies in Europe. Carbon price is one way, but we can also look at developing markets for decarbonised end-use products. There's a lot of nice studies that have been done which show that the relative increase, the price increase you see in decarbonised raw materials like cement and steel gives a much lower relative increase in the cost of final products like buildings and cars. So here we can see, a 25% increase in the cost of steel, 70% increase in the cost of cement translates into negligible end-use cost increase. Another nice study here from Stinsev looking at the construction of this Lake Pontchartrain Bridge in Louisiana. So big infrastructure projects like this can obviously be incentivized to use low carbon products through low carbon public procurement. Another US initiative to highlight is the Federal Buy Clean initiative, which is looking at developing these mechanisms. We also need better product certification behind that, and marketing and labelling of those products to foster consumer demand. Another little look at this kind of thing, study from Chalmers University in Sweden on the Preem oil refinery looks at the cost of capturing Scope 1 emissions from that refinery and how there's, again, kind of a negligible price feed through onto the cost per litre of petrol. So this might be a good place for oil companies to start looking to find some CO2 to put in their stores. But of course we do need the market to be developed and the regulatory drivers put in place to ensure there's a driver to make cleaner fuels. So all these are kind of emitter-focused mechanisms, and I think we've seen that it's sometimes difficult for these kinds of regulations or subsidies to feed through the value chain to help to storage development. So how about we create a parallel market for storage? I'm sure many of you are familiar with this idea from Professor Miles Allen in developing a market for CO2 storage through a carbon take-back obligation. fossil fuel extractors, oil and gas producers have to store an increasing percentage of the carbon they produce. And this is a driver which really puts the imperative to act in the hands of those with the expertise and capital to do so. So I'm going to do a quick summary. In the US, there's a lot happening, we've already heard. Land of the free market, but there's a lot of subsidies. In Europe, a lot of industries getting nervous about high carbon prices, but they need a way to escape those prices and decarbonise, and for that we need infrastructure in place. And something CATF is really advocating for in Europe is a coordinated strategy for CCS, which can put a regulatory framework in place for a regional network. End user demand for low carbon goods is one way we can move beyond subsidies more easily and support that cost pass through down the value chain. At the same time, we should be thinking about creating parallel markets for CO2 storage. So that's all I wanted to say. Running short of time, so.
Thank you very much, Toby. And actually, you hit the time perfectly and fit in an enormous amount of material there. So that was really, really interesting. I'd now like to introduce Allan Baker from Societe Generale. So Allan has worked in the energy sector, the power sector in particular, for more than 30 years, initially as an engineer and then in finance. And Allan has been playing a leading role in the carbon capture and storage field for a long time, in particular, having served on the UK government's original CCS forum and leading the commercial section of the CCS cost reduction task force. Allan, over to you.
Thank you. So I'm very conscious that I'm keeping you from lunch. I'm not going to be sure the questions are going to be simple. I was asked to look at what we can do to get to subsidy-free, but I thought it might be worth having a look around, what we're seeing around the world in carbon capture. As you said, I've been around the industry for a long time. It felt like I was a teenager when I joined, and now sort of approaching retirement, sadly. But what we are seeing actually now is much more of a sort of global view of carbon capture, certainly in the UK. The business models that are being developed are a big step forward in terms of, from the finance community's perspective, in terms of making the industry bankable, potentially. There's still a bit of work to do to get from where we are now to final contracts, but reasonably optimistic we'll get there, which is good. But also we're now seeing the US, as we've seen in several presentations, coming with very, I'd say, generous tax incentives and a very clear tax policy, which is enabling them to sort of move forward fairly rapidly. And we're involved also in advising carbon capture projects in the world, and it slightly pains me to say that the first project financing we close in CCS may actually be in the US, but I'm still hopeful that we get there in the UK first. Clusters, I think there's been a move towards clusters, certainly in the UK, obviously, but we've seen that emerging as a theme around the world. We've seen, in the US, the very large CCS projects for hydrogen production, for example, in Texas and Louisiana, which are using that cluster concept to try to get volume into the business, volume being the key thing for reducing cost and stepping a bit closer to the subsidy-free objectives that the industry's got. But I think we can't also ignore non-hub or non-cluster connected projects. So some of the shipping solutions that we're seeing developing around the world, including in the UK, including Northern Lights, obviously, in Norway, are very positive as well, I think, because they bring volume into the industry. They enable emitters that are not connected to the clusters initially to actually find a sink for their CO2. And in Asia, actually, that kind of ship solution may be more sort of custom built for that region, simply because of the geography and the storage sites and so forth. So that's one area that we're really focusing on again, but it's helping again to create this global view of how carbon capture could work. And I think this is all positive for the industry, I have to say, and I'm sometimes a real pessimist depending on where we are in the cycle, but it's all very positive for the industry and creating this kind of global momentum, this global perspective that carbon capture is something which matters, is really important to the finance community. And it's creating confidence that maybe was lost after the you know, the cancellation of the last UK competition, for example, but it's now creating a buzz in the industry. And going back to the question before about how do we motivate young people to get involved in the industry, I've got 7 or 8 people in my team now around the world working on carbon capture projects. And there's nothing like motivating people by having the actual experience of working on a live project with the expectation of closing something. So the more these projects get developed, the more projects we see coming forward to the finance community, I think the more people, certainly in my sector, we're going to see actually choosing to work on carbon capture instead of offshore wind, instead of onshore solar or wind. It's becoming sexy. I really daren't say it, but it's not a particularly sexy subject, but it's becoming something really interesting, I think, to the younger generation looking at clean energy. We're seeing different drivers as well now. Certainly in the past, when I looked at carbon capture from a finance perspective, it seemed more like a pilot project, a concept. Does it work? Can we make it work? What does it take to develop one of these projects? We've gone now well beyond that, I think, with the net zero targets, actually making people realize that you need carbon capture. You can't get to net zero in most people's view without carbon capture. It's given, again, a new impetus from a finance perspective because it now features in policy. You've no idea how frustrating it was to go to the EU 5, 6, 7 years ago and hear them talking about carbon capture being something we may need at some point, and let's focus on renewables, because even then we knew, in our minds, our analysis said you actually need CCS. So the fact that there's a consensus in policymakers, in regulators around that now is really important in driving the industry. ESG, we touched on ESG. I was asked to mention ESG. I go back to the comment that one of the previous panelists made, that ESG is the reason why there's a massive wall of finance focused on clean energy. Everybody is refocusing their balance sheet, refocusing their efforts away from fossil fuel towards clean energy, whether it's renewables, carbon capture, hydrogen, because that's the direction of travel and that's what's being demanded by energy transition. But ESG doesn't solve risks. So again, going back to the comment about the New York bankers, if you ask the same question in London, will you take more risk for an ESG project? The answer is going to be no. It's not a panacea for risk. So I think, when we're looking at these projects, and they are first-of-a-kind projects, the technology isn't first-of-a-kind. We've financed it in various industries, but putting the technology together, building a massive project on the scale that we're talking about now is first-of-a-kind for financial institutions. We need to get the risk allocation right, and we need to get it right first time. If we have a full storm where projects have technical problems, projects struggle, projects default, God forbid, on their debt, then the industry is going to be tarnished from a financing perspective. So, it's why we're focused on working with government, working with projects, to try to make sure that the first projects that get built are on a risk allocation that works for the project, works for the sponsors, works for the banks, and enables us to close a project that's not safe because everyone's taking risk in that scenario, but a project that we believe can be successful. And I think setting that path for the future, starting on a strong footing for the future, is what we've seen, or I've seen anyway, previously in the independent gas-fired power business when we developed the first projects based on offtake contracts, gas supply agreements. The first projects were very conservative. The third, fourth, fifth project started to be actually pretty aggressive. And then we got to a stage where we didn't need contracts at all, and banks and sponsors felt they could do the projects on a merchant basis. We've seen the same now happening in offshore wind, another good template. It takes time, but if you get the foundations right, then the industry actually takes off quickly and finance is mobilized to the industry quickly. And I think we've seen the value of that in terms of getting close to subsidy-free. And there's a good comment about what is subsidy-free, because in reality, subsidy-free doesn't mean risk-free, it doesn't mean merchant necessarily. You need something to, from a financing perspective, some revenue stream which is stable. You need somebody who's willing to enter into a contract if you don't have a subsidy to dispose of their CO2, and somebody who's creditworthy, so they have to have a financial motivation to do that. That may come from ESG, but it's more likely to come from some form of tax penalty on carbon emissions. So the whole subsidy-free debate, if you like, is also wound up in how you motivate people to actually capture and dispose of their CO2. So we will get to subsidy-free CCS in the sense that I don't think we need necessarily government support, but it's still quite a long way to go when we haven't yet sort of got to lift off in the industry. So I'm optimistic, but let's get the first projects done first and underway, and then we'll see how long it takes to get to a subsidy-free industry. So I will leave it there.
Thank you very much, Allan. Another really interesting presentation and another very positive view on how things are developing. So I know that we're standing between you and lunch, but I think it would be really good to take about 5 minutes of questions from the floor before we go ahead. So I think there are two people with roving mics, and I'm looking around now for hands. So please introduce yourself, and we'll take, I think, 3 questions at a time. The gentleman over here.
Carl Jeffrey from Carbon Capture Journals. A question for Allan. I'm trying to make sense of this GFANS development because it looks like a really big news for investors if it gives a green light for ESG investment to be counted if there's carbon abatement involved, but nobody's mentioned it, so maybe it's not such a big deal. I don't know if you have any comments on if it's a big deal or not for carbon capture.
I mean, potentially it can make a difference. I mean, I think, as I said, ESG needs to be separated from risk to a certain extent. I think there are or certainly banks have got an incentive to invest in clean energy from an ESG perspective. I think it's clearly the direction of travel. So any initiative, any scheme which encourages that, I think is going to be useful to the CCS industry.
Thank you, Allan. Any other comments on that question from the panel? No. Any other questions from the floor? The gentleman over there.
Chet Billiok, Petrofac. This is a question to Allan. You mentioned the first closed deal for CCUS in the US. It's been alluded to already, particularly by Steve, about dealing with performance and putting guarantees in place to enable the financing of such projects. So my question is, how was that particular issue dealt with in the deal that was closed, if you could share? I'm
not sure I can say too much about the detail of the structure of the project. It's not yet closed. Obviously, once it has closed, there'll be more information in the public domain. But again, it's the same principle I think we're seeing in many other projects where there's a risk sharing. And certainly we're well aware of the issues in the supply chain about taking risk. Banks don't want to take that risk, sponsors don't want to take those risks, but you do need to get around the table and come up with a risk allocation which makes sense. And whether that involves some support from government or not, in terms of managing that risk, or whether it can be covered by subsidy, ultimately, is something which is still being worked out in different jurisdictions in different ways. But certainly, hopefully, next year we'll be able to say more about projects closed as opposed to projects we're working on, and it'll become more clear.
Thank you.
Thanks, Allan. We're working you hard here. There's another question here.
Kevin Dale from the PSGB CCS Forum. I've been in this room for 4 hours now, and I haven't heard the topic of carbon credits discussed in any detail. And I thought this session in particular, it would come up, but it hasn't come up. Is that because you really are not keen on the idea of carbon credits?
Thank you. Valborg, would you like to?
Yeah. Thank you for asking that question. I would really like to elaborate because we have a 3-party MOU with Ørsted and Microsoft looking at decarbonizing Ørsted's bioenergy plants in Denmark. And by doing so, you achieve negative emissions or carbon credits, as you say. And I believe certainly that the development of this voluntary market is extremely important to accelerate the business. Like I said in my presentation, storage is a bottleneck. So we have to look at really all mechanisms. It could be CCU, but it could also be commercial projects because of carbon credits.
Thanks, Valborg. Anybody else on the panel like to address that question? Toby?
Yeah, I mean, I think it was mentioned on one of my slides. There's certainly a massive problem for the removals market in Europe, that there isn't really an incentive beyond these voluntary markets. And I mean, the EU is currently, as part of its Sustainable Carbon Cycles initiative, is currently developing the certification framework, which is really what we need as a basis to provide value to removals and hopefully provide some value to BECCS and direct air capture, which are higher cost but more permanent and more accountable methods of removal. So yeah, I mean, it's urgently needed.
Great. So one more question over here, please.
Hello, Brian Sweeney, Calix Limited. Fascinating morning. Thank you very much for your inputs. I've missed anybody commenting on the carbon price. Maybe I've just missed it, but the question I think I'd like to put to the panel is, should the CCSA be advocating a larger and deeper carbon price? It just seems to me that the carbon price will motivate people away from the expensive high carbon things. It will help boards to approve projects to reduce CO2 from their products. It will help fund financiers to come and finance projects, and it will take the burden off government subsidy and government treasury. Shouldn't we as CCSA be pushing for more carbon price?
Great. Steve, would you like to go first on that one?
Yeah, I mean, obviously, interesting question, and I think, I mean, from a financing perspective, you know, it does come back to what Alan said. It's the risk and the sort of the deliverability of those revenue streams attached to a project. So, you know, if we're talking about, you know, changing incentives through a higher carbon price, then, you know, clearly that may make, you know, drive different incentives through companies, through the markets as well. So I think, yeah, of course, it would drive a different type of activity. Yeah, but where would that charge be passed on to? Where someone ultimately has to pay for this, and it sort of does come back to, you know, is it taxpayer, is it consumer, who is paying for those measures? And similar to the previous question as well around the credits, you know, if there was a market delivering, you know, a long-term market in carbon credits, and no doubt over time that will develop, then financiers will be able to look at those markets and potentially lend against those carbon credits as well. I think what we've got at the moment is just a very nascent sort of market in those credits, and therefore, you know, to the point made earlier, it comes back to bankers for what is the risk, how confident are we around those revenue streams to finance these projects. But that is potentially an argument for sort of looking at those measures to actually incentivise companies to change.
Thank you. Valborg?
Yeah, I like to follow up. I think long term, this is the mechanism that Europe has selected to ensure that we reduce CO2 emissions. It's easy to get distracted these days because of the geopolitical situation, because of a potential recession, potential sale of allowances from EU, and so on. If you ask me 6 months ago, I could share with you that, you know, the average estimate of the ETS by 2030 among analysts would be 130 euro per ton. Right now, I think everyone is very short-sighted, but in this industry, you know, we are building plants, we are building infrastructure for operation for 25 years. So we have to think beyond that. So I support, you know, certainly that this is the mechanism that Europe has selected, and then we have to act accordingly.
Thank you. Any final comments from Toby or Alan?
I would just add that, I mean, we're seeing carbon price top-ups, additional taxes in Denmark and Netherlands, which is definitely driving investment, and yeah, I think it's crucial. It is the end game, but industry needs to be helped along the way by putting infrastructure in place.
Brilliant.
You don't, as well, from a national perspective, you don't want a carbon price to force somebody to go somewhere else where they can produce more cheaply. That's the other challenge of using that as a stick as opposed to a carrot. Although a CFD struck against the carbon price goes back to Steve's point about creating that stability. And there you have got a mechanism which, if the carbon price goes above the CFD strike price, then the money's going back to the consumer. So in a way you can combine the two to give you the stability you're looking for. Because the point is a good one about the forecast of CO2 prices, because if you speak to people on different days, they're going to have a different forecast, and that's very difficult for a financial institution to take that risk. So you need to hedge it somewhere.
Brilliant. Well, thank you all for participating in a really interesting discussion, and a special thank you to our 4 speakers. So next up is lunch until 2 p.m. And then after that, there are a set of focus sessions. So focus session 3, how to encourage and embed new carbon capture technologies. And focus session 4, how do we make CCUS the mainstream? Thanks all.